Hi, I'm Molobeng Serame. I will be giving you a masterclass on the transition from IAS 39 to IFRS 9 with a specific focus on the banking sector and specific focus on credit losses. So one of the major things when I approach an accounting standard is I break it down into the four major categories of any standard. Number one, it is classification, and from an IFRS 9 perspective, there's been a change in how we can classify loans. IAS 39 had one definition of loans and advances, and we had to, and that was it, and you recognize them at amortized cost, whereas in the IFRS 9 world, you've got an amortized cost option and fair value through profit and loss option. And then the second approach I take with an accounting standard is after I've classified an asset, in our case, being a loan to a customer, I would say, then how do I measure this asset? Do I measure it at historical cost? And what does the standard say? And the standard is quite clear on once you've defined or classified an asset as in one category, you can, in the IFRS 9 world, you can either measure it using amortized cost or fair value. One of the main changes then with the transition from IAS 39 to IFRS 9 was from a credit loss perspective, in the IFRS 9 world, you had to wait for a loss event to happen, depending on what you meant, what you defined a loss event as. So in a banking world, a loss event would be you missed your debit order. Therefore, I can start impairing you. Whereas in the IFRS 9 world, you don't wait for a loss event to occur. You say, what is the likelihood of a loss event to occur in the future? And IFRS 9 is quite clear. We have three categories of your portfolio of assets, and it takes a three-stage approach, whereas stage one is your very good customers who are not defaulting, they pay you on time, they behave well, they don't have bounced debit orders, etc. And then you move on to stage two. And also the main change here is stage one, you take a look at what the 12-month outcome of that loan is. So I'm saying to you, I give you a loan today and I classify you and I say, what do I think you're going to behave like in the next 12 months? Then there's a middle area, which is stage two. And stage two says where you have, where there's been a significant increase in your credit risk. And maybe I should take a step back and say, how do we define credit risk? It's simple. I give you a loan. As a lender to you, there's a risk that you might default on your payment. So when there's now a risk that you may not pay me on time, even if you've paid me the last, I don't know how many months, 60 months, the minute there's a sign or an indication that you might not pay me, I have to say there's been an increase in your credit risk. And the standard is quite clear that whereas for stage one, I take a 12-month view, stage two says, give me a lifetime view of this customer. 12 months ago, would we have possibly predicted anybody accurately? No, because nobody predicted we'd have a global pandemic. And then stage three is similar to what we had in IAS 39, and that is from 90 days of default, you are now in stage three, you are impaired. So we don't have to predict anything from you, but we need to predict what our loss will be over the lifetime of that asset again. So when you step back from what the different classifications are, there's been two nuances, or rather significant changes being introduced, and that is you have to take a futuristic view instead of wait for a customer to default. And that means you have to model as best as you can. You make a lot of estimates, you make a lot of judgments. Whereas in IAS 39, I wait for you to miss a payment, then I say, this guy, shaky. Now, taking an exam perspective, I would say the obvious things here we had to do. We had to do a change in accounting policy, disclosure. We moved from IAS 39 to IFRS 9. Number two, IFRS 9 has a lot of estimates in it and a lot of judgment. One bank may have completely defined the significant increase in credit risk differently. So we have to disclose how we define significant increase in credit risk, we have to also say what are the estimates we've made and what are the judgments we've made, because I could use different assumptions in my judgment. For example, COVID happened, nobody predicted COVID. Maybe someone can predict, I think interest rates are going to drop or they're going to go up, and how do I think this customer is going to behave when interest rates increase? Most customers behave one way, and then how do customers behave then when interest rates decrease? And you have a lot of variables that come to play. If a customer is susceptible to foreign exchange risk, what happens when the ZAR, the rand, deteriorates versus when against a stronger rand? So are you dealing with an importer? Are you dealing with an exporter? So all those variables come to play, and then you build a model that says, how do I think this customer's risk increases given the following assumptions being made? And it's been the most difficult challenge to us banks, because you have to take a 24-month view on every single customer. You can't predict 24 months. We can't even predict a day from now, just given how volatile everything in the world is. So it's a major change in how we historically measured and classified our assets. Judgment, estimates, and taking a forward-looking view, and a lot of assumptions are being made. From a disclosure perspective, obviously we have to disclose our accounting policy. We have to disclose the assumptions we made and the judgments we made and the models we used and how we classify each financial asset. I hope this has been insightful, and I am always available to take any questions. You can send them through our social media accounts. Thank you for watching. I am Molobeng Serame, Business and Commercial Credit Portfolio Manager at Standard Bank.